Hello, guys. I want to have a simple chat with you guys right now about what's going on with the Fed. We got some new information here. Just in the last few days, Fed Chairman Powell come out and he said, we're going to be patient. Just that one word. And the markets interpreted that as him meaning that they're going to not have any interest rate hikes all through 2019. Now, I don't know where they got that no interest rate hikes through all of 2019, but the Fed's caught in a trap right now. If they back off the pedal, you see, just by him saying one word, patient, the market interpreted the Fed as backing off the pedal. The Fed's not really backing off the pedal, but you see the reaction to the dollar? Look at the dollar. The dollar's just fell and fallen all day. It's been falling for the last few days, ever since he made that remark. All the Fed's actions have been to support the dollar. When the dollar started to heat up, when gold was $1,900, they suppressed the price of gold. That worked for a while, but just like any medication, after you take it a while, the effects wear off, and it starts to not work anymore. And that's the way with knocking the gold price down. It worked for a little while, supported the dollar for a little while, but then the effects started to wear off, so then they had to do more. So what they did then is they used the banking system. And they've been using the banking system to suppress the price of gold and silver by selling naked short contracts into the market, basically, and selling short contracts and selling these SLV and GLD more than they actually have physical supply. That's how they suppress the price of gold and silver. But how they suppress the price of oil was that they used the banking system the same way they use the banking system to suppress the price of... I mean, let's face it, the biggest players in suppressing the gold and silver price have been bankers like J.P. Morgan. Okay, but how they did oil was they used the banks to put out loans to oil companies. High-risk ventures in shale oil production. And when they got that money, of course, these ventures in shale oil production were going to go out and dig wells. That's exactly what they did. They went out and dug wells, and what happened is we got a boom in American oil production. Knocked the oil price down, okay? They're still in the effects of that. But what that did is that drove the dollar up all the way up through the 80s, through the 90s, the oil, when they did oil. Because it's a petrodollar, it drove the dollar all the way up to like 103 on the U.S. dollar index. But like anything, after a while, the effects started to wear off, and the dollar started to drop back down into the 80s or whatever. So what did they do then? Well, then they come along, and they're in this program now of withdrawing liquidity from the system. $50 billion a month, again to support the dollar. And the whole thing, along with raising interest rates. Basically, they've had their foot to the floor on the pedal, just going steady at this. And what's happening is it's starting to have this effect where the dollar gets too hot, too high, and emerging markets start to have trouble. The world starts to have trouble. The dollar is what you have is you have capital flows coming in, and this is why they've been buying all these bonds, especially on the short end of the yield curve, and they've been driving the bond yields up. What we're looking at is headed toward, actually, well, we had a small inversion of the yield curve, but the whole thing is the Fed is trapped right now. If they really back off, I'm not talking about playing around like him saying, okay, we're going to be patient, but say they really do something, like they come out and they say, hey, you know what? We're going to start quantitative easing again, and we're going to do away with quantitative tightening, and we're going to lower interest rates back down. Well, him just saying we're going to be patient had this much effect on the dollar. Can you imagine what the effect on the dollar would be if they did that? The whole world would know at that point in time that the whole game is up, the jig is up, that the Fed can never stop They can never stop. They have to continue to constantly create new dollars. Well, we already know this, but it seems like an awful lot of people out there in the world, they don't understand this, that the Fed can't stop. But the Fed is stopping, and the reason why they can't understand it, the Fed can't stop, is it seems like the Fed is stopping. They're doing this quantitative tightening, and they're doing this raising interest rates and everything, and everybody says, hey, you know what? They got confidence that the Fed has got this under control. They got this. They got it. They got it. Look, the Fed's raising interest rates. Look, the Fed's doing quantitative tightening, and they're getting away with it, and they're doing it. They're actually doing it. They can only do it to a point, though, because you can't take an over-leveraged system like we have. It's just the debt. The debt has been over-leveraged. We got all these bubbles, asset bubbles and everything. You can't draw liquidity out of the system like that with all these bubbles. They'll all pop. But the Fed's got away with it so far. But what they've caused is they've caused volatility in the system. This volatility is manifest because of the Fed's trap. And so what we're headed toward is a crisis, because the Fed's not going to stop. The Fed's going to keep drawing $50 billion a month of liquidity out of the system. And that's having, my estimation, that's having a bigger, more profound effect than raising interest rates. But I think they're going to continue to raise interest rates too. They're just going to let the market recover. What happened was the Feds got scared. And so that's why they come out with this statement of patience. The Fed got scared with the market falling like it was. And so now what they've done is they've come out and they've said we're going to be patient. And that doesn't mean anything, because they have to continue raising interest rates. They have to continue. One of the things is, take a look at all these pension funds and pension accounts and everything else. Everything's going to go broke if they keep interest rates down near the zero mark. Banks can't afford, banks, take a look at these low interest rates. Banks make their money off of interest. You know, higher interest rates are good for the banking sector, you know. And I'm going to tell you what, the Fed has a mandate to support the banks. And they can't let the system, just as basically getting down to the nitty-gritty of it, is the Fed at this point is caught between the devil and the deep blue sea. If they go backwards right now on all of their programs and everything they're trying to do to support the dollar will start to head toward inflation. And they know this. And they can't control inflation, and they know it, right? They can't pour money on inflation and stop it. They can always stop deflation. So they're saying to themselves, we got to keep it toward deflation, not let it get too hot into inflation. They're trying to balance this, but there's no balancing a system that's over-leveraged, and it continues to get more and more over-leveraged all the time. The problem goes back to 2008. Actually, the problem goes back a lot further than that. The problem actually goes back to when this entire financial system was originally set up, back at the Fed, when the Fed started back then. And back then it was fine. The system relies upon constantly expanding, industry expanding, everything expanding, and expanding the credit to match the expanding world. Right? But our planet is not infinite. And what's happened is industry and everything is spread through the whole world. They've built cities, they've done everything, right? And you can't keep expanding the credit in a world that's not expanding anymore. A world that starts to contract, the whole world starts to contract. You can't keep expanding credit, because the underlying world is what supports the credit. So what happened was, leading up to 2008, they finally got to the year 2008, from 1914 when they started the Fed. About 100 years had passed, and during that time the world expanded out, and the world went through its first contraction. Actually, everything started to contract. So what did they do? They expanded in 2008 when the world contracted, and we went into the 2008 financial crisis. What did they do? They expanded the monetary supply. So the world was contracting, but they were still expanding the credit out. You see? So what's happened is this has never been flushed from the system. What we got is we got a stinking toilet that's full of everything, and the plunger's never been used on it. Okay? This is the problem. It's got to be plunged. All of this debt, all these bubbles and everything have to pop. They won't let it pop. When it starts to pop, they come in and support it by expanding the credit more. And that's what they're going to do this time. Just like in 2008, they came into the rescue and they expanded the credit. What's going to happen this time is, this time when it starts to contract, it's going to be a big panic all over again, and they're going to expand the credit all over again. But you can only go so far with this before the people start to notice, hey, the purchasing power of our currency is gone. And they start to spend. See, it's a very delicate balance here between inflation and deflation. And what the Fed's doing is going to cause deflation. You just can't keep drawing $50 billion worth of liquidity a month out of the system. It's an accumulative effect. Every month you keep adding to what you've already withdrawn. You have to realize this money that they're drawing out of the system is the same money that they put into the system during quantitative easing to support the market. Now they're sucking it out. So what happened? Well, back in January, we had the first tremor. The market fell a lot, very quickly. Scared them, right? They came in with a punch of liquidity. That was enough to stop it back then in January. Now we've seen this last episode of market volatility was even stronger, had more power to it, more intensity to it. Well, they've came into the rescue with their statement, we're going to be patient, okay? Now the markets went back up again, somewhat. You know, we're somewhat back into a rally. They're going to do everything that they can to keep this rally going. It's probably going to put a lot of pressure on them to make this new trade deal with China, right? But the end result of all of this is they're going to reach a point where a couple more months, a month will pass or another month, and they're still drawing that liquidity out. Another 50 billion, another 50 billion. It's going to hit a point. I can't tell you exactly where that point is, but it's going to hit a point where all of those 50 billions that they're drawing out of the system is going to take away the underlying support of liquidity under the market. And the market's basically going to be hanging out over free air. You know, the same thing happens with puddles in the wintertime. If you've ever observed puddles, you'll get a freeze or whatever in the fall, and the puddle will have about an inch of ice on the top of the puddle, and the water will drain out from underneath, and you'll have this layer of ice sitting over nothing. Kids love to go out there and jump up and down on those and crunch some, those ice. But the thing is, there's nothing supporting the ice. It's the water underneath that supports the ice. Water's like money, is like liquidity, drains out. And that's what's going to happen to the market. The liquidity that's underneath the market is going to drain out. And that's what's already been happening with this volatility and these crashes. Not really crashes, but these, you could call them corrections, but, you know, like 1,000-point drop sort of thing. That's what's happening, you know. And the longer this goes in, the deeper we get with this, the more we're headed toward something that's not going to be pretty. Seriously, not pretty. So I'm waiting for it. I know it's coming. There's not a chance in the world it's not coming. We just got to let the Fed continue drawing that money out, the $50 billion a month. And also, they're going to be forced into probably making at least probably 2 more hikes next year. At least 1 or 2 more hikes. Those are, now that they've already hiked and hiked and hiked and hiked, they're getting up to a point now where even those 25-point basis point hikes are becoming very meaningful. See, when they first started hiking, it was only like 1/4%. And it was like, no, what's that? No big deal. It's nothing. You know? Then another 0.5%, you know, 1/4%, and they got up to 0.5%. Still nothing. And they added another 0.75%. Still nothing. But once they passed 1%, and then they passed 2%, suddenly it's starting to be something. And now, every one they add now, cumulative on top of it, is going to add that much more icing on the cake. prepare for it. This crash is not going to be pretty, but it's going to be very short-lived because when the crash hits, it's going to be rather severe, and the Fed is going to step in. It's as simple as that. When the Fed steps in, everything's going to change in all of these markets. Things that have been going down, things that have been suppressed all this time are going to go up, and the things that have been up are going to come down. Okay? And basically what I'm really referring to is gold and silver are going to be huge benefactors of this when the market turns. But the problem is your dollar is going to start to lose purchasing power, even though gold and silver are going up. But gold and silver are going to go up much more than the purchasing power that you're going to lose. So than they are now, because they've suppressed the price so long. Gold and silver are like a coiled spring, you know? And in fact, just the Fed talking. You guys have been watching, you notice that gold and silver are already up a little bit from what they were, right? Just the Fed's talking, and the dollars went down, and gold and silvers went up. Just the Fed talking and saying, okay, we're going to be patient. Okay, listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye-bye, guys.